investors is I help them by giving them sharing the discount with me, and then selling them what is also known as a partial. So when you buy the whole note, I have the flexibility to offer you on a 30-day note that I just rehabbed a loan and made it reperforming. What I do is I offer you 10 years of that 30-year loan. So that I get to share the yield with my customer. And for the next 10 years, that note is going to pay you what was going to be paying me. So at the end of the 10th year, then the note comes back to me, and I allocated that for my retirement so that I get on the cash flow from that aspect. And two things get accomplished. One, you and I share the risk. So if I lose, you lose, right? So.
All right, guys. Hey, welcome to another episode of the Practical Wealth Show. So we're going to talk about cash flow. So put this on the principle 5, velocity of money, right? Because your goal is to get what we call is the glorious position of FU, right? Which is passive income greater than expenses. So let me talk. So my guest today is helping you get to the glorious position of FU is or the path to FU. All right, let me stop. I'm gonna get in trouble with somebody. Yeah. And Al Curiel, right?
Yes.
And Al is let me get your bio here so I can give you proper respect. And he's the president associate in real estate holdings, right? And he founded in 2015. He's got 35 years of business experience. You want to learn from people that are doing it or are doing it and have done the thing, right? And how he's become an expert in just about every facet of real estate. During his career, he's been involved in wholesaling, flipping, rehabbing, renting out properties. In addition, he's dealt with seller financing, performing, non-performing. I've never heard of reperforming notes. Okay. And he's an active participant in the note industry. So we're going to talk about today, amongst other things, are his love for notes and his transition, more so into that space. And Al wants to make sure that the business is conducted with the highest level of integrity. He's lobbying for the creation of regulatory board focused on protecting the rights of investors. Giving back to the community is also important. He's uses that real estate expertise to rehab affordable homes in Rockford, Illinois. And since 2007, he has been volunteering with the Special Olympics. Al, welcome to the Practical Wealth Show.
Thank you, Curtis. Thanks for having me.
Yes, sir. So tell him what I didn't tell him, and what's your what's it called? Your origin story. Like, did you get bitten by a radioactive spider and now you've got superpowers? Like, what's the what's the backstory?
I've been around a long time, Curtis, so I'll try to be as brief and give you the Reader's Digest version of the chapter of my story in notes investing. I'm an immigrant and born and raised in Mexico City. Came to the U.S. in 1975. I'm 62 years old. I was 15 years old, and I always took an interest in real estate and cash flow. So without any knowledge, my brother and I in 1982 invested in our first property. I'm going to give you some names of people that probably are unheard of to your audience right now because they're the young captive audience that you have. But I read books by Dave Delgado.
Yep.
Carlton Sheets.
How old is you? Carlton Sheets. I have his course.
There you go.
Yeah.
And the cassettes.
Yeah.
Nowadays don't know what cassettes
are. I do have the CDs though, but yeah, I have both. Right. I have both. Yes.
I'm a little older than you, so I can tell you the cassettes that were, playing on automatic and what have you, find the tracks. And Dr. Albert Lowry also. So without any formal training, Curtis, I just reading the books, but I had this desire for cash flow. So my brother and I enter into this adventure, I call it, not venture, but adventure back in that day. And our first deal was a quad, not vertical, but a horizontal quadruplex. And we saved all the money that we had and we put a deposit, closed it. Came to find out that the apartments were run by people of less than stellar integrity. One of them was a stripper that was seldom paying the rent. The other one was raising chinchillas in the bedroom, and that was, the smell coming out of there was incredible. And then the owner of the building was living in one of them, and then the fourth one was the kicker. These people were so bad, Curtis. They had the utilities cut off. They were not paying the rent. And to feed themselves, because they didn't have any gas, they used the bathtub and put the charcoal in there and put some kind of a crate, and they were grilling. So that was my first experience as
Wow.
a real estate investor. Of course, we recovered. We sold that building at a loss, but we persevered, continued, and we're fairly successful with the rentals. And then the market happened. October 29th of 1989, the first crash that I've experienced in my life occurred. We were highly leveraged. The interest rates at that time were in the 11 and 12% range. Of course, we lost it because we were highly leveraged and we were young. Decided to pivot from that to fix and flips. We were doing fairly well with the fix and flippings after we had some more capital and recovered from that. Got about 36 units sold and fixed and turned over, and then Y2K came. Actually, a year before Y2K, because people didn't know how the market was going to react to the new computer systems and everything else. The computers, if you recall, you may not recall, they were not equipped to handle the year 2000.
I'm older than I look. Just
remember that? I mean, I remember.
Yeah, I remember all that.
It was bad.
Our career is similar, except for I was, a registered rep, so I lived through all those crashes, and I just saw them on the paper side, know. And then right. I got fed up not knowing why stuff happened. Right. And that's what led me to what I'm doing, because I started studying. I was like, all right, I don't want to know. If somebody tells me that, oh, don't worry, the market's going to come back, I'm going to punch him in the mouth, because I don't, I need to know why things happen. But go ahead, it's not about me, it's about you. So
I mean, it's true. You hear about all the Debbie Doomers out there, and it's bad. You always recover. We are entering another period like that, but then after 2000, we decided to pivot again, and we got into the wholesaling thing. We did things reversely. We should have started with wholesaling, but that's beside the point. So wholesale happened again, and it was great. We're just assigning the contracts and what have you. And then, of course, we all know what happened in 2008, 9, and 10, which was when we had the great recession. So at that juncture, my brother was already had a family and what have you. And he says, okay, with inventory drying up, he's going like, okay, Einstein, what are we going to do next? And he says, I have a family. I can't continue to do this. So he left. I became a one-man operation, a solopreneur. And that's when I discovered the power of notes investing. And I've been doing notes since 2009, 10. When I found the inventory, where the inventory of notes, of paper, not of properties, but of notes were, and I decided to invest in it, and that's what I've been doing ever since.
That's awesome. Thank you for that. And so one of the things I want to highlight, guys, investing is when we talk about the 3 rules of investing, Al, but we one of the things that we tell people, investing is about becoming something, not about buying something. And so your progression has showed you've become, throughout the whole process, you've become an expert in all of these areas. So you can speak to that, and that's what you want, somebody that's becoming. So I wanted to show them, success leaves clues. Everybody wants you to tell them what to do, but if you want the power, you don't have to beat your head against the wall, but if you want the power, you do have to do the thing and become an expert. And that makes you a better investor. Right? So
I think so.
So let's talk about notes. Why do you so talk about the market, because right now we're in a wonky market here. And so why do you think that do you think that the market conditions create opportunities for, expanding real estate holdings through note investing?
Without question. I think, Curtis, one of the main things that people need to realize is that you make money on the buy, not on the sell.
Mm-hmm.
And right now we are approaching a period of time where there's a correction. Everything has a correction in real estate on average between 10 and 12 years. So we were long overdue. We didn't learn our lesson back in the subprime market of 2008, which is what caused that correction in 2008, 9, and 10. So we learn through, as you say, success leaves clues. And I think one of the main things to know is that when you buy something, when time is down, when the market is down,
Mm-hmm.
is you can buy assets at a discount.
Mm-hmm.
So when you buy the assets at a discount, all you can, this is where you become knowledgeable with non-performing notes, is when somebody is not paying their mortgage because they either lost their job, they got a divorce, or whatever. So I like to be tough on the problem and soft on the people. So when I buy a note from the bank or a hedge fund, I always get the discount so that when I work the loan out with a homeowner, I have the latitude to discount the fees, to discount the interest rate, to discount the terms, to adjust, to pivot, in other words, and then accommodate that homeowner to the 11th degree more than the bank ever could, because the bank doesn't have the personnel to foreclose on everybody.
Right.
They don't have the manpower to handle all the lawyers to file all these foreclosures. So because we are a one-man operation, I have that flexibility to deal with a homeowner on a one-on-one
Mm-hmm.
and work with them on adjusting the terms. And then when I do that, then I have a positive cash flow now,
Mm-hmm.
because I go from having a non-performing note to reperforming, right? And now that new adjustment allows the individual to pay me the mortgage. I become the bank.
Mm-hmm.
And not with the same degree of rigid approaches that the bank does.
All right, so let's back up. I just want to, just for, let's see, news listeners, a note, tell them what a note is. A note, performing, non-performing. And let's start. I want to go basics, and then I'm going to go forward.
Well, a note is basically an IOU.
Mm-hmm.
A check is a note.
Mm-hmm.
Okay, a cash is a note. Anything that is of value. So a note is the IOU, the promise to pay for something. And in this case, the note is the IOU, and the deed and the mortgage or whatever is a security instrument that guarantees that you are going to collect no matter what. That's a collateral.
Mm-hmm.
So if somebody defaults on their obligation to pay, I can always go and take the house. I don't do that. That's not my intent, but that's a security instrument that makes it a very viable investment.
So instead of buying the property, you're buying the paper that the property, because see, what a lot of people don't get out is that a lot of real estate investors see I always tell them, I said, you see the asset as the property you just bought, right? But if you learn to think like the bank, they see that real estate as the collateral, and their asset is the note, because what they want is those payments back with interest over time.
That is correct.
Yeah. And so what you're saying is you can buy those. A lot of people don't realize you could buy those.
Yes.
Okay.
You can buy notes
at a discount. Like you can, get $100,000 mortgage for what, 60,000 or.
Well, I was going to say, for performing notes, those are notes that are paying obviously on time. That's truly passive income. Now, why would a bank or a hedge fund want to sell a note that is paying? Well, a couple of reasons. Number one, because that investment for them has lost its luster, and they have more than recovered the interest rate that they want for their stakeholders. That's number one reason. Mm-hmm. The second reason, Curtis, is simply that the bank or the hedge fund whom I buy these notes from need to lend more money out, so they need to redeploy more cash. So that gives them the incentive to sell notes that have been paying for 10, 15 years, mm-hmm. maybe less, obviously 5 mm-hmm. to 10 years. Mm-hmm. They are fresh enough so they can still be desirable by somebody like me who is looking for cash flow. Right. So that's the one reason. So they sell me that note. Let me give you a very simple example. $100,000 note. On a performing basis, you can probably get it for $85,000 to $90,000.
Okay.
Right?
That's
So that's the cash. So the 10% is your discount. So that's your yield. So then on the flip side, if bank is not receiving payments because I lost my job, I got sick, I went through a divorce, whatever the reason, I'm not paying my mortgage, the bank doesn't want to deal with lawyers and doesn't want to deal with paperwork. They don't have the capacity to do it. So they sell me their non-performing notes, the ones that are 30 or 45, 60 days late, and they sell me those at a greater discount because they're not paying. They're saying, okay, we are releasing us from this. We're giving the responsibility to Al Curiel. He can deal with a lawyer. He can deal with somebody that can process the foreclosure. We are out. For that $100,000 loan, we can sell it to Al for about $60,000. Right. So now my job, just like you can rehab a house, Curtis, you can rehab a loan. Obviously, now not swinging a hammer, but with a pen and paper. How do you do that? There are different ways to rehab a loan. One of them is to modify it. The other way is to get cash for keys. You've heard that. Deed in lieu. And the last and least desirable circumstance is reaching foreclosure. But because I deal with the velocity of money, and here's a concept that we talked about before,
right?
My investors that buy notes from me are on the East Coast and the West Coast. They don't want to invest with me and wait 3-4 years before a foreclosure takes place, right? They want their money to be working for them. So what I do is I look for notes to buy notes in non-judicial states. Why non-judicial states? Well, simply because in non-judicial states, such as Texas, Michigan, Georgia, etc., those states, their laws are so favorable to investors like me, because if somebody is not paying their mortgage, I can foreclose on them in 60 to 90 days, 120 tops. I don't invest in my own state of Illinois. Why? Because the laws in the state of Illinois preclude anybody from really foreclosing on somebody earlier than 6 months. You have to wait 290 some days in Illinois to foreclose on somebody from cradle to grave.
Wow.
I can't afford that, right? I need to pay my clients what they want their yield to be on a timely basis. So if somebody gets behind on their mortgage, I immediately take action. I try to go through the 3-step thing. Modify their loan. If they can afford it, then I get cash for keys. If they are being stubborn and they give you a hard time, then I go to foreclosure. If I go to foreclosure, then I know that within maximum 120 days, I'm going to have the deed back and I'm going to have control of that. Now, when I do foreclose successfully, then I am no longer in the note business. I am now back in the real estate business, because now I have the property as well as the paper. Right. So my job then, the seller financing portion of it is, if I do happen to foreclose on somebody and they vacate the premises, then I simply stick a sign on the front lawn that reads, "Seller will finance this house to deserving buyer with large enough down payment." Why do I do that? Because if I advertise as, "Apply for this loan for this house, I'll sell it to you with no cash, no credit, no income," guess what? I'm going to have that problem.
Right.
So I am very upfront with people right away. You want this house, I will finance it. I will run the risk, but you need to come up with a large enough down payment, and I'm going to run credit on you.
I think that's, I see that as really, because entrepreneurs solve problems for a profit, right? And so the ability to modify is huge, because they could just be going through a tough time. And since you bought it at a discount, you could cut their payment $100, $200, $300 a month, whatever you want to do, because you can afford to do that, and because they want to stay there, and you're still getting your payments. You're not losing money because you bought at a discount. So it gives you the flex. So if you look at it, I'm going to help these people solve their problems, stay in their home if they're good, quality people. And then if you have to foreclose, because a lot of different people don't have exit strategies. So what I hear is you have a lot of ways to get out of it that don't cost you money. And then the worst case is to take the property, and then you basically create a new note. Right.
Correct.
And then there's there's a number I heard, like 67% of people don't qualify conventionally. Right. And so, but they have the money. They could be a contractor, just doesn't they have the cash flow to give you the down payment, but their credit's not good because they've been aggressive on their taxes because they didn't want to give up any money. And so, but you could give them 2 years lease option to buy whatever for 2 or 3 years and give them time to get themselves together and then sell them the house.
That's exactly.
It's a lot, I love that.
That is exact. You hit the nail right on the head.
Oh my goodness, I love that.
And this is an example that I'm gonna show you. With this, that will summarize basically what you and I have been just talking about. Number one, Joe Smith, he gets behind on his payment, right? And $140,000 house, and this happened in 2009. This is a case study that actually did happen to me. 2010, I believe, 2012, this happened. So Joe, let's just call him Joe Smith, he got behind, and the hedge fund that I bought this note from didn't have the patience to deal with it. So I bought the note. It was a $160,000 house. The loan was $102,000, and the house had dropped in value to $90,000, Curtis, right? 140 value prior to the market crashing, $102,000 mortgage, $90,000 value. So that meant that he was upside down.
Right.
So I bought the note from XYZ hedge fund, and I got it. So then my servicing company, I can't do it because individuals can't do that. But let's just say that they spoke on my behalf, and they said, Joe Smith, today's your lucky day. Joe Smith's like, why is today my lucky day? I said, well, because now Associates in Real Estate Holdings is your bank, is your new bank. And he said, well, I've been dealing with such and such hedge fund for 4 months, and I've never gotten the courtesy of return call. Right. So now you're telling me this is my lucky day. Why is this my lucky day? And then we went to say, well, that loan that you had for $102,000 and $140,000 house that has now dropped in value, guess what we're going to do? We're going to lower that balance to be the same as your mortgage, as your house, $90,000. We're reducing that to $90,000. You're taking a $12,000 haircut? Yes, we are. Okay. And that interest rate of 6% that you had with a hedge fund, we are going to reduce it now to 4%. And those 5 months that you were behind, Joe Smith, those late pays, we're not going to make you pay those back, the interest and the penalties. We're going to put those charges at the end of the loan. So instead of making it a 30-year loan, we're making it a 30-year and 4-month loan. Right. And to do that, and we are going to give this a try for 90 days. So now that we know that we lost your job, you have a lower paying job. Now we are going to requalify you and adjust the terms just like we told you. He says, great. So we went from a payment of, let's just say $1,000 to a payment of $700, Curtis. So that's why that day was his lucky day, because I happened to have purchased that note, that $100,000 note, the $102,000 note. I bought it for $14,000.
Wow.
And that was back in 2008. Those days are long gone. Those will not come back. But what I'm trying to say is that the impact of that market adjustment was such that the discounts were deeper in a time when you could buy and realize a pretty decent cash flow. Now, I was lucky enough that Joe got a lower paying job. He did get a paying job. It was lower, but I was able to pivot and readjust the payments. And now, ever since 2012, the guy's been paying on time.
Right.
Right. Because he sees now, his wife sees him as a hero because there are flowers in the flower bed. Mama don't want to move, and they get to keep the house.
Right.
So it's a win, win, and a win. So that's a prime example of what you and I were just talking about.
Yes, that is awesome. I mean, and you still won because you got still a $90,000 asset, the note, for $14,000.
Right. Correct.
And so that gave you the room to help him. And can you get these? I mean, so those, do you see, I got so many things running through my mind right now. Do you see, because if you look at the economy, I try to teach people to think from a macro standpoint. So it's like, okay, we've got high interest rates, we got inflation, we got this and that. So on the other side of crisis is opportunity. Okay. Right. And so but you've got to learn to see the unseen, like the opportunity, or work with somebody like you that sees the opportunity. But what aren't they seeing? Like, what are you seeing that people aren't seeing there where you see the opportunity? What is the opportunity?
Right now, what I see the opportunity is, I don't want to be a Debbie Downer again, Curtis, but I see the market adjusting again. The inflation continues to go up. I see the interest rates continue to go up. The petrodollar now has been an issue now because the Chinese and the Russians are now in bed together, and they are really basically sticking it to the Americans and the rest of the Western world, saying we are no longer going to rely on the dollar to rule the price of oil. We are not going to go the Chinese currency, the Russian currency, whatever. So there's going to be a major adjustment coming up. I believe that. I could be wrong, but that's just my opinion. My opinion, right. 7 cents will get you nothing more than a postage stamp. But looking at the market conditions, I really see some opportunity continuing to stay with the performing notes aspect, and a little bit more in-depth opportunity with the non-performing notes because of two things. Number one, you have the natural adjustment of the market. Number two, you had a thing called COVID that got in the way. The inventories from 2008, 9, and 10 correction, Curtis, you were still feeling the effects of that waterfall from that. So back in 2020, that was still not wrapped up completely. So right. Here comes COVID, hits you like a ton of bricks. So now industry stopped, but the world didn't stop. People still had to make, right. live in houses. They still had to eat, and then you had to add insult to injury. You had the supply chain issue. So that was a perfect storm of three different components, political and otherwise, that the market was not counting on. So with that, you had the big what was that resignation, the great debt resignation. All the employees says, I'm not going to work anywhere else because I can't get paid. So I'm just going to work from home and get into the self-education industry. And everybody became an expert, and everybody had webinars and everything else.
Right.
Well, now with that came an adjustment in real estate prices. So all of that has created a tsunami of inventory that's still lagging because it's still not processed. So I think that you'll see some inventory coming from banks and hedge funds that had been sitting there for about 4 years that can probably be realized will have greater discounts come probably in the next 6-7 months.
And we're talking about residential.
Correct.
Primarily.
Primarily residential.
Residential. Okay.
Yes, sir.
Yep.
Yes.
Because I was talking to somebody in the commercial market. They don't even talk about that. That's completely that's crazy.
That's a different animal altogether.
Yeah, it's a whole different animal altogether. Okay. I like so this is a shameless, not plug for me, but I want you to talk about because you do what I teach, right? Which is, the strategy.
Yeah.
Of what I'm working on a book called Money for, we're bringing out my favorite author, Jeffrey Reeves, Money for Life. But infinite banking, right? Using properly structured insurance to pay as a place for storage, right? Because the question I ask people is where you store your cash. And so before we start recording, you say, well, I've got about 11 of these whole life policies. Can you just tell them how you use it in your process? So here's the formula that we teach, Al, is get money. So it's earn money, right? Bank it, save it somewhere that allows you to be the bank, borrow against or collateralize your cash value, spend it. What can you spend it on? Big ticket items, or in your case, assets, notes, and then repay it with interest and then wash, rinse, and repeat. So how long have you been doing that? And so I want you to tell y'all new listeners, Curtis is not crazy, okay? And this is what smart people do with their money. Tell me your experience with that, and then I want you to tell them about your firm.
Sure.
And we'll go from there.
Sure. Well, a disclaimer for everyone: Curtis is not crazy.
Okay. Thank you.
And this works like a charm, and you have to know where to go. There are certain life insurance companies that buy into the concept of infinite banking, where you basically you become the bank.
Right.
And what I have done is I have about 8 or 9 dividend paying whole life policies that I put a huge deposit on, $10,000, $20,000, single premium. I guess that's what you call it, Curtis. I'm not much into your space. This is what I've been educated on from my professional here. and I buy these policies, and then I get the cash, access to the cash right away.
Right. Right.
And what I do is I extract that cash to buy notes at a discount. I get title to the notes. I get through the cash flow that comes in. I reinvest it and pay that back loan for my life insurance. I replenish the cash. I continue to pay myself, and like Curtis says, just rinse and repeat. Do it for
And so when he has that money out buying the asset, it's still in the policy making money, right? So the only difference is where do you store the cash? Because you could do it in a self-directed IRA, you could do it from your bank account, but what you're missing is, what if you do it the way he's talking about it, you're more efficient and you recapture opportunity costs. You basically get to have your cake and eat it too.
Correct.
Okay. So that's all I want. I'm gonna just go there because I want to show people that whatever you're investing in, if Nelson Nash used to always say everybody needs two businesses, the one that gives them a paycheck and the banking business, right? So you can finance the stuff, so you can marry into the family, and because you're really the bank, so you're taking over buying. So really, you're creating a note to buy another note. You own the profit, and it's just like a big velocity. It's all velocity, right?
It's all velocity.
It's all how fast can I turn this money. And so we're taught what I call the accumulation theory, which is buy and hold, dollar cost average, get out of debt, buy term investor difference. But when you break down people with money, it's velocity, it's cash flow, it's leverage, they buy permanent insurance. And so success sees clues, and you can call that corporate finance. That strategy works in personal finance. So I just wanted to bring that home to show that. So tell them a little about how you help people participate in it. That's the business, right? You help people participate in the note business with you.
Right. Well, yes, I do. I have again, I have my Roth IRA that funds some of for my own personal portfolio, right? For when I retire, when I start my pension, and then I also that's why I have so many policies, Curtis, because some of that goes right into my business,
right?
Which allows me the flexibility to buy at a discount, and that's why I'm offering my non-performing products. And after I rehab them, the loans, then I put them all on my corporate and sell them to my investors. So how I help the investors is I help them by giving them sharing the discount with me, and then selling them what is also known as a partial. So when you buy the whole note, I have the flexibility to offer you on a 30-day note that I just rehabbed the loan and made it reperforming. What I do is I offer you 10 years of that 30-year loan. So that I get to share the yield with my customer, and for the next 10 years, that note is going to pay you what was going to be paying me. So at the end of the 10th year, then the note comes back to me, and I allocated that for my retirement so that I get on the cash flow from that aspect. And two things get accomplished. One, you and I share the risk. So if I lose, you lose, right? So if you lose, I lose, and vice versa. So I share the ride with you, and I manage the process for you, so that if somebody is behind in paying their mortgage, I still have to make you whole, Curtis, right? My responsibility is, because you're not a note person per se, you're just an investor,
right?
As soon as you stop getting that cash flow, I get involved, and then I try to again recapture, make it reperforming, whatever. So you're not in risk of doing any of that. So then at the end of the 10th year, two things may happen. Number one, you may be, oh, I like this return on my money. That's great. Al, let's continue doing it. Let's buy another 10 years. So now for the next 10 years, now that's a 20-year mortgage now that you're getting, then you continue to get the cash flow. If the mortgage pays off early, you even get a bigger yield because there's a payoff on that mortgage. So we both get to share what the success of the performance of that note is going to be. So, and I do that habitually. That's what I do with my non-performing notes. And what we're doing now is also we are going to be engaging in a teaching series, like a 3-day webinar where we teach people how to invest in notes, performing, non-performing, and reperforming, as well as seller financing, through the use of meditation, which is a completely new concept. It's it's a thing that I've discovered in our marketplace. We are focusing on the minorities, the Latino community,
Mm-hmm.
and we find in our market that a lot of our folks, a lot of our customers, uh, they invest in real estate, Curtis. They invest in. We all have shiny object syndrome, right?
Mm-hmm.
And we always try to buy the courses and do the things and get engaged for a minute, and then we forget about it,
Mm-hmm. Mm-hmm.
right? And that comes from a mind from that mindset of scarcity. I think that we all have the power to have a power of abundance. And one of the things that you need to reach that level is to believe. In order to believe, you have a whole new system to take action.
Right.
In order to take action, you have a different mindset. And the meditation hopes to achieve that.
Mm-hmm. I love that. I mean, you got to take action. And so most of this game is mental. And I think that a lot of people want to skip that part because they want to get right to the doing, right? But it's be, then do, then have, right?
Exactly. You
And
got it.
so, and you got to work on the being because Al's become a good real estate investor, right? But there's discipline. There's I was listening to some tape this morning. I have Kobe Bryant's book, The Mamba Mentality,
Yeah. Yes.
Black Mamba, right? And so
Yep.
you have to develop a Mamba mentality about so you get up and do some work and do some research and work out, and you just have to get the discipline to be that person,
You
and
have to.
or vetting the operator to make sure that you're comfortable with them. That's why you want a person with high integrity, and you just you still. Somebody told me I did an interview a couple weeks ago. You want to be an active passive investor, right? You
There
want to
you
know
go.
what's going on,
That's
and
well
not
said.
just it's not a mutual fund where you just hope it goes up. You want to pay attention, and so I like that our money is in bed together.
That's right.
Al, tell them how they can follow you and get involved in what you're doing.
Sure. Well, you can reach me at it's a long name, so please bear with me. You can
Okay.
ask information from info@associatesinrealestateholdings.com, and that's again Al or info@associatesinrealestate.com. We have this 3-day seminar coming up at the end of June. I think it's going to be a lot of fun. My business partner is going to handle the motivation part of it, the mindset. She's going to go through a whole litany of exercises. She is quite excellent at it. And then after we get their mind squared away and ready to go, then I get into the investment part of what's a note, what's performing notes, what not performing notes, et cetera, and so on.
Okay. All right. So that's cool. You might want to email me that later so I can have all the links right,
Absolutely.
right, or send me the links to it. If you have links and schedule, prepare for that. If you send to me, we'll put them in the show notes.
Oh, excellent. I will do that.
So because he said Latino, he said people of color, right? So
yes.
if you like me, you can come too, because he's going to be
Absolutely
doing it in English.
Everybody's welcome. Everybody's welcome.
Everybody's welcome, right? So
everybody's
money's
welcome.
green.
And the thing
Right,
is, I emphasize that is only because we're going to do it in both languages, Spanish and English. So everybody's welcome. And maybe I didn't mean to.
No. I just wanted them to know that you can come and you want to because you're talking about a person that came here from another country with nothing and carved out financial freedom, and that's what you want to do. I mean, it's and I like that story of nobody wasn't born with a silver spoon in your mouth. You really use the opportunity that is the United States with great countries. Got a few people that are a little off course, but that's all right. You can still win.
All right. Nobody's perfect, right?
Right.
Nobody's perfect, but
you can still win.
That's
and
right.
That's the thing. You can still win with the right mindset, the attitude, the whole thing. That's what you have to work on. That you got to understand economics is major, as Jim Rohn used to say. And there's a problem that needs to be solving. And so if you're entrepreneurs solve problems for a profit. And then Al just gave y'all a win-win-win scenario, which is you can't ask for more than that. Everybody wins.
Everybody's winning. And again, look at this mirror right here. This immigrant kid came here, and I have been blessed with a really decent living, a very comfortable way of living, and I just like to pay it forward and see other people progress.
All right, let's do it. Al, thank you so much for being on the Practical Wealth Show, guys. We'll put this out in the show notes. So if you like it, leave us a review on iTunes. And also, this will also be out probably sooner than the iTunes on YouTube. And so you can watch us there, subscribe to the channel, and again, leave us a review on there. Al Curiel, thank you so much for being on the Practical Wealth Show.
Thank you for having me, Curtis. Had fun.